Right now, literally billions of dollars in tech investments are on a very quiet, very dangerous collision course with harsh macroeconomic realities. Welcome to this explainer. Today we're going to unpack the specific data points and the hidden financial mechanics that will dictate whether the current AI boom actually survives. We are absolutely at a true market crossroads here.
We'll structure our analysis in three quick parts today: the catalyst, the vulnerability, and the macro pivot.
All right, let's jump right into part one, the catalyst, and the current market fulcrum.
7%. I want you to just let that sink in for a second. That staggering number represents just how massive a weight Nvidia currently holds in the S&P 500 index. When a single company commands that much gravitational pull, it completely shifts how we have to evaluate risk. It's no longer just a tech story, it's a systemic market story.
Because of that incredible weight, on the eve of its earnings, Nvidia acts as the market's ultimate fulcrum. I mean, an Nvidia problem is literally an everyone problem. A breakdown here immediately increases the downside risk for all tech-heavy indices. And it's fascinating to watch their cautionary stock action versus their really aggressive business bets. They've delivered a relatively staid 15% year-to-date gain for 2026 and have actually sold off after earnings in the past 4 quarters. Yet they are still out there making massive moves, like their fresh $6 billion weekend investment in the AI startup Poolside to challenge Chinese AI models. The market desperately needs a beat and raise quarter here, just to confirm the sheer velocity of AI spending.
So that brings us to part 2, the vulnerability and the impending revenue gap.
Because beneath all this surface-level tech optimism, there is an alarming trajectory in the AI revenue gap. We are looking at a financial chasm that balloons from $200 billion back in 2021 up to $600 billion in 2024 and to a frankly staggering projected $1.5 trillion by 2026. This brings us to what the source accurately calls the $1.5 trillion question. The big takeaway here is that the gap between total AI infrastructure investment and the actual revenue being generated by AI, it's compounding at a really dangerous velocity. And, fewer people seem to care about the answer until they absolutely have to.
To understand where that massive gap even comes from, we just need to run the AI data center math. Okay, so you take Nvidia's projected revenue of $700 billion, add in data center costs, which are estimated at roughly twice the chip cost. Then you add the cloud margins, which represent the provider and product markups. You run that whole formula, and the math requires a mind-boggling $2.1 trillion in end-user revenue just to break even. Until we hit that threshold, this whole AI boom is entirely a build-it-and-they-will-come story.
When we contrast the different players in this space, the reality check is pretty striking. On one side, we have the core infrastructure. These are companies like Nvidia, with eye-popping backlogs, fat margins, and a hyper-growth yet totally reasonable PE ratio around 19x. Then you have the application layer, growing, sure, but currently insufficient, with OpenAI at a $27 billion run rate and Anthropic at $46 billion. But then, on the fringes, we have the speculators. This is where cautionary hubris lives. Take the Situational Awareness Fund, managed by a 21-year-old with literally zero prior experience, based entirely on a 165-page manifesto, managing $45 billion before completely unraveling. It goes to show that hubris is vastly outpacing actual commercialization on these speculative edges.
All right, let's pivot to part 3, the macro pivot, and the hidden battle for capital supply.
If the tech industry is going to need trillions of dollars to survive this swelling revenue gap, we have to look at the hidden battlefield that provides all that cheap capital. The answer lies in a macroeconomic tug-of-war over bond yields. On one side, you've got players like Stanley Druckenmiller and Scott Bessent betting on higher yields, arguing that government intervention just won't suppress them amidst ongoing inflation worries. But on the flip side, you have Frank Flight at Citadel Securities betting on lower yields, and his argument relies heavily on the July PCE inflation context. With year-over-year PCE expectations dropping to 3.6% and core dropping to 3.2%, Citadel's indicator is showing low market stress. If those metrics cool as expected, it kicks off a loop that provides the exact cheap capital the AI sector desperately needs.
So how does this bond market mechanism actually provide that cheap capital to the tech sector? Well, it all comes down to a fascinating step-by-step sequence of market behavior known as the Citadel short squeeze loop. Let's quickly walk through it.
The loop starts with extreme positioning. This is where trend followers place historically high bearish bets on rising yields. Then comes the catalyst. A benign growth or rate outlook sparks a minor bond rally. This triggers the squeeze, where bears are forced to meaningfully unwind to cover their shorts. That unwind causes bond prices to spike upward, which results in yields dropping significantly. The really crucial point here is the historical precedent. Across 64 comparable episodes since 2003, this exact loop causes yields to fall by an average of 12 basis points over 60 days and 25 basis points over 120 days. That drop in yields, that is the absolute lifeblood for tech capital.
But we have to ask the scary question. What happens if that benign inflation data doesn't come through? If that bond market squeeze fails to materialize, AI companies are going to face what our source defines as the debt wall. This is the terrifying point where companies burn right through their cash piles before that $1.5 trillion revenue gap can close, hitting a wall precisely as the bond market restricts access to cheap capital.
And this sets up our climax, a direct, inevitable collision course. On one side, we have the tech dependency, an era living on borrowed time, requiring trillions in cheap capital. On the other side, the macro wall, where long-term borrowing costs remain fiercely contested thanks to government debt supply and lingering inflation anxieties. If these two forces crash into each other at the debt wall, it's game over. The survival of the entire AI boom depends almost entirely on this bond squeeze proving correct.
And we actually have historical warning lights about assuming that capital alone solves all problems. Take a look at California's high-speed rail project. The latest price tag is $126 billion. That's nearly 4 times its original estimate. It was approved 18 years ago, they have 0 tracks laid, and the target operational date has been pushed all the way to 2040. The lesson here is a direct juxtaposition to the $1.5 trillion being poured into AI. Just throwing capital at a problem does not automatically conquer physical infrastructure bottlenecks like power availability, land acquisition, cooling systems, and local permitting.
Furthermore, when we look at these real-world bottlenecks, we have to impartially account for geopolitical and social friction. For example, we're seeing an escalating US-Canada trade war right now, with Canada described as punching with a swagger never seen before. This threatens major political consequences in swing states like Maine and Michigan. Simultaneously, there's tech pushback at the grassroots level. A diverse civic coalition called DFLOC, made up of everyone from IT pros to democratic socialists, is aggressively protesting AI surveillance tech being deployed without civic consent. This mirrors the exact same local anxieties we are seeing over the construction of massive AI data centers. This social and political friction is a very tangible, real-world barrier to tech deployment.
Looking ahead to tomorrow, your radar needs to track some very specific events to see which side of this collision course is going to prevail. On the corporate side, keep an eye on earnings from Salesforce, CrowdStrike, HP Inc., J.M. Smucker, and Kohl's. But even more importantly, watch the macro triggers. You want to look at the July PCE index, which is the Fed's preferred gauge, the Q2 GDP revision, and the July durable goods forecast, which sits at 0.5%. These metrics are what will dictate if that crucial bond market squeeze triggers or fails.
Finally, stepping away from the heavy economics for a moment, our culture ticker highlights some fascinating human elements. In music, we're noting the rise of breakout pop star Olivia Dean, who actually almost didn't release her billion-stream arena hit because of crippling perfectionism. Over in nature, thousands of people are flocking to coastal Maine to spot Atlantic puffins, often called the harlequins of the sea. And in legacy, we honor Dolly Parton, who passed at 80, remembered as a full-fledged movie star and Hollywood powerhouse. So, as we wrap up this explainer, it leaves us with one final provocative question to consider. As our society wrestles with trillion-dollar AI data centers and rapidly shifting macroeconomic realities, how will tomorrow's cultural and human shifts intersect with, or maybe even rebel against, today's massive technological leaps? Keep that in mind as you watch the markets this week.